Today's video is going to be something special. I wanted to share with you my top 10 investing laws that will hopefully keep you safe when you're starting your investment journey and allow you to invest with confidence. Let's jump in. Hi, I'm Joe Macek, Portfolio Manager with IA Private Wealth and your host of Investing Made Simple. And this video was a video I've wanted to put together for quite some time, as over the last little while I've seen a ton of new investors want to get going in the stock market, but understandably may have had a lack of a basic knowledge when starting out. So if you've ever been on a group chat and asked the question, hey, I have $1,000 to invest right now and I have no idea how to get started, this video is for you. In the next little while, we will walk you through my top 10 investment laws that I use in my practice every day and what you might want to do if you want to invest safely and with confidence. With that said, this video is the first step in what I hope are many steps in your journey towards financial independence. And please understand that it will be difficult to jam everything into one video, as learning to invest is a continuous process that may take you some time to fully understand. But before we get into it, I'm adding the usual disclaimer that I normally do for my videos, and I would also ask that if you like this video and you find the information useful and valuable, please feel free to share it with people that you know. Also, I would love it if you'd smash that like button for the YouTube algorithm, as it really helps out my channel. And if you want to be kept in the loop with all of my latest videos, please hit that subscribe button and darken that notification bell. All right, the very first law I will be talking about is perhaps the most important law. Pay yourself first. I cannot tell you how important this law is to building your wealth long term. Nothing impacts the growth of your net worth more than your savings rate and the law of paying yourself first. You see, when you start out, you get a job, then you get an apartment, and then when you start to have a few bills, you may not realize it, but many people start to pay those bills first and neglect to save cash for themselves later. You see, the most important bill you must pay first is you. I'm going to say that again. When you start working, the first and most important bill you pay prior to paying anything or anyone else is yourself. What does this mean? Well, the first 10% of any money after tax you make on your paycheck goes to your investment account to make investments into companies that will work hard for you and make money for you while you sleep. So for example, if you earn $500 after tax on your paycheck, the first $50 or 10% should go to your investment account, and then all you have left is $450 left for the rest of your bills and your spending. You see, many people do the opposite and pay all of their bills first, and if there's anything left over to save, then they save the remainder of their cash, only to find that there isn't a lot of remainder cash left over. Leaving cash to the end doesn't typically lead to a higher net worth at the end of the month. The good news is many millennials are actually super good at saving, and they're saving at a much higher rate than this. However, if you find you can't save as much as the 10%, that's okay. Find a percentage that works for you, say 3% or 5%, and start immediately and consistently paying yourself first, as this is going to be very powerful going forward for the rest of your life. When you are starting off, it's important to remember the percentage you save isn't as important as starting to save. So make sure that you start. Take an amount, any amount, and start now. As well, many investors think rate of return is the most important thing when it comes to investments, but I can assure you it isn't. It's actually the amount you save, or your savings rate. If you save 10% of your earnings and earn just 1% rate of return, you will have more money than if you save 1% of your earnings and earn 10% rate of return, as we can see in this chart over 30 years. We took a person earning $35,000 per year and compared the two using a 10% savings rate and a 1% savings rate of the gross salary to be saved for comparison. And we left out any taxes or other variables to simplify the example. The line on the bottom is a 1% savings rate with a pretty aggressive 10% compound rate of return long term, which I would say is going to be fairly difficult to consistently do on that long-term basis. However, for the purposes of this example, let's say that you did just that. Going this route, you would have, after 30 years, $63,330.20. However, if you had saved 10% of your earnings and earned just a paltry 1%, which is in fact many GIC rates today, after 30 years, you would have almost double the amount of $122,964.59. mindset. What happens if we save 10% of your earnings and earn a return which is more achievable, like 7% per year? Well, now we have a grand total of $353,755.64, a sizable difference, showing the importance of having a meaningful savings rate. Paying yourself first also helps train yourself to live beneath your means. Have you ever wondered why some professional athletes or celebrities that seemingly make millions and millions of dollars, or even hundreds of millions of dollars, go bankrupt? Have you ever asked yourself, how does a person making 10 or 20 million dollars per year run out of money? Well, it's simple. No matter how much you earn, if you spend more than you earn, you will eventually go bankrupt. If you make 10 million a year and you spend 20 million a year, you eventually will run out of money. There are many examples of professional athletes, celebrities, lottery winners that have spent well more than they have earned and went bust. Paying yourself first can help you learn how to live beneath your means naturally. So make a commitment today to pay yourself first and pay as much as you can towards yourself. Rule number 2, don't touch the principal you save. The principal you put away should be there forever. Why? Once you have a significant amount of principal invested, you can use the principal to generate dividend income for you, so your money can work for you and pay your bills for you. There's a saying in our business, you can shear a sheep many times, but you can only skin them once. Your principal is the sheep, and the dividends are essentially the wool. You can shear that sheep many times for the dividends, but don't skin the sheep once for your principal. If you start dipping into your principal with your spending, you are essentially skinning the sheep, and you can only do that once, so make sure that you shear only the dividends going forward. Now, as you are saving, should you happen to reinvest those dividends into the principal, now those dividends become the principal and should remain untouched to generate further dividends. Rule number 3, if you want to win the game of net worth building, keep score. Every month, keep a record of your progress by starting a net worth and cash flow statement. You might have noticed all throughout this video, I haven't described it as building wealth, but rather building your net worth. Building wealth is, in my opinion, a very soft way of describing what you could be doing versus building your net worth. Your net worth is a tangible amount calculated on a regular basis. And in order to do really well with investing, I think it's very important that you calculate and track your net worth on a monthly basis. For those interested in getting a free net worth and cash flow calculator that you can download and use to get started right away on keeping score, please email me and I will send you a link to get started. I will also have a video on how to properly use this calculator and graph your net worth and cash flow over time. But simply put, your net worth is all of your assets if you sold them today for cash and paid off whatever debt you might owe. The difference between those two numbers is your net worth. Your cash flow is your outgoing expenses against any dividends or passive income you have coming in. In the template, though, we will only be including your passive income, meaning any income you get from dividends, rentals, and other investments, not your regular career income. Why? Simply because I want you to see how much more dividend income you need to be able to completely stop working, as your dividends at that point would exceed your expenses. Keeping a monthly snapshot of both of these balances will hopefully encourage you to be disciplined over time. And when you eventually look back at your progress, hopefully you will become very excited about how far you've come, and that will drive you to save and invest further. However, with that said, some months the market may not do well and your net worth may seem to go in the opposite direction. That's okay. Record it and continue to invest. Eventually, markets usually do come back and your net worth should rise accordingly, and you will hopefully see the incredible progress you are making. On your cash flow statements, once your passive income exceeds your expenses, you would be what Robert Kiyosaki says, out of the rat race, meaning you no longer have to be gainfully employed to cover your expenses. With that said, I would now recommend a couple of books for you at this time. These are Rich Dad, Poor Dad by Robert Kiyosaki and The Richest Man in Babylon by George S. Clason. These two books are what I would consider must-reads when starting out your net worth building journey. Rule number 4, do not day trade. I know this law is probably going to draw a lot of controversy, but I thought I would say it anyways. Do not day trade. Every day, it seems on social media, there's a post about a day trading system that guarantees you thousands of percent per day and how you can day trade for a living, making money consistently in the market. No. There are very, very few successful day traders out there. And the reality is, most are so unsuccessful that they wind up going broke soon after they start day trading. Statistics show most day traders go completely broke or quit within 1 to 2 years of starting, and most successful investors that you read about do not day trade. In fact, one of the most successful investors of all time, Warren Buffett, does not day trade. The wealthy and the affluent investors also do not day trade, and I would argue you shouldn't either. In fact, for Warren Buffett, he is constantly talking about buying and owning great businesses at reasonable prices for years on end. I heard an excellent saying in the business a long time ago, and if there's anything you take from this video, this is it. You should treat your portfolio as if it's a bar of soap and handle it the least you can, because the more you handle your portfolio, the less of it you're going to have. Also, the whole point of investing your money is for your money to work for you. When you day trade, you are still working for your money. You have to do research, watch the trends, stick bids in, hedge yourself, battle timing issues, and worry about being whipsawed by larger funds out there taking out your stop losses. All of this, and you will likely be worse off. I would think the last thing anyone would want to do is add another full-time day trading job to their current full-time job when you don't have to. Buy great companies once with great dividends and or great growth prospects, and add to your positions week by week, month by month, year by year. And let the companies that you invest in do the heavy lifting for you. Rule number 5, buy on red days. If the market is up and the color is green, be patient and wait for a red day when the markets are down. This will train you to recognize down days as days where you're getting discounted prices on stocks. Even if you see 6 red days in a row, that's okay. Buy on red days. Just think about it. If you are young, do you want green days or do you want red days as you are not done saving yet? I see a lot of young people out there worried about a crash. Why? When you are young and starting out, you have decades of investing ahead of you and very little money at risk because you just started saving. You aren't done saving yet. Why on earth would you want the markets to go up right away only to have it cost you more money to buy these great companies? When you are young, I would argue that market crashes are your friend, and taking advantage of those lower prices today could make a massive impact on your net worth tomorrow. Buy on red days and learn to embrace them as stocks are on sale and be happy you are getting a deal. The stock market isn't something that you can negotiate a lower price on. So when the stock market says your stock is on sale, take advantage of it. Rule number 6, adhere to the 10% rule. When it comes to exposure and weighting within your portfolio, this is a critical rule to follow. And with very few exceptions, no stock should be worth more than 10% of your overall portfolio. Meaning, if you have $10,000 as a whole invested, with very few exceptions, no individual stock should be more than $1,000. Why? Because no matter how much research you do, no matter how good the stock is, no matter how good things should go with the company, any stock can go to zero for any reason at any time, and sometimes they do. This rule applies to any stock, even large cap ones where you think it might be safer. There's a saying in our business, it's never the bus that you see that hits you, it's the one that you don't see that hits you. Many portfolio managers do not exceed 10% in their portfolios when they buy a stock. In fact, many portfolio managers have a hard time exceeding 5 and 6% of an overall weighting. You can see this as an example in many mutual funds, and we can show you these here. Do not exceed the 10% rule. Larger concentrations or weightings can lead to larger mistakes, and larger mistakes can lead to larger losses. How does this work? Well, if you have a 10% weighting in a stock and it goes bankrupt or loses a significant amount, all you have lost is that 10% of the portfolio, which allows you to recover that 10% very easily with your other stocks. Higher amounts of concentration could make it that much harder to recover overall if something goes wrong. If you lose 50% of your portfolio, you now have to make 100% to get even. So it's very important to watch your weights and don't go over that 10% weighting. A common question I get is, do ETFs count as a stock? And depending on the type of ETF, I would argue no, because ETF stands for Exchange Traded Fund, which means that the ETF has many different stocks in it, and your money is automatically split up or diversified when you buy the fund or the stock. Hence, you are adhering to the 10% rule. For example, if you had $1,000 to invest and you happen to choose IWM, which is an ETF of the Russell 2000, your $1,000 is split up up amongst the 2,000 companies in the Russell 2000, which is still adhering to the 10% rule. Rule number 7, by and large, stay away from penny stocks. This is going to be another controversial rule, as I see a lot of young people buying penny stocks. But any stocks trading on the smaller exchanges, trading for 10 cents or 50 cents or 70 cents, I personally and completely stay away from, and I would suggest they are not generally a great investment. Buying the bigger companies with dividends and good growth prospects allows you to buy these companies in sizable amounts, and you will likely be far better off than owning penny stocks. There's a common misconception that if you buy larger amounts of shares due to the price of the shares being 25 cents, you have a better chance of making more money because you own more shares. I can tell you right now, after 23 years in the business, companies only increase their share price over time because the business is making more money and the growth rate of the company is increasing. It is not because the company is 10 cents. It is just as hard for a company priced at 5 cents to double in value and go to 10 cents per share as it is for a company to go from $20 per share and again double in value to $40 per share. Do not be seduced by the smaller share price of penny stocks. Whether you buy one share of Amazon at over $3,000 US or you buy 30,000 shares of a company at 10 cents, the probability of your stock appreciating is not better because you own more shares. It's often worse. The best example I can give you is the shares of Berkshire Hathaway, where one share is worth at the time of this writing over $400,000 per share and still moves by the same percentage moves as any other company. Penny stocks are often companies without earnings and are usually considered startups, and the failure rate with startups is quite high. Buy good large businesses that make money, pay dividends, and as a good rule of thumb, stay away from the pennies. Rule number 8, stay away from any stocks that you see promoted or featured on financial news programs. Financial news networks do not make money by giving you great advice and awesome stock tips. They make money by selling advertising to as many viewers as possible. And the more viewers that tune in to watch these financial programs, the more they can charge. So is it any wonder why they feature the wildest and craziest stories they can find? They are not paid to give you advice. They are paid to advertise. Do not get caught up in the wild and crazy stock news stories that the networks feature. Now, don't get me wrong. I love the content, and the stories that these networks produce are very entertaining. But that's all it is, entertainment. These programs are not at all to be confused with sound investment advice that comes with building your net worth by prudent portfolio management. A recent perfect example is the story of GameStop and AMC with Wall Street bets. The people whom got involved with trying to trade those wild and crazy swings mostly got hurt. And as a general rule of thumb, by the time it hits the news networks, the market has already adjusted and the returns are probably not going to be there for you. Watch the financial networks for entertainment and to get some basic news, but get advice from a licensed advisor. Rule number 9, when starting out, try to keep your trade costs as low as possible. But when you build up and you have sizable money at work, it's often best to work with an advisor. When you are beginning to invest with $100 or $200 a month and your portfolio is just starting out, transaction costs and fees can have a larger impact on building your net worth quickly, as they can represent a larger percentage of the value of the trade. Why? Because if your trade costs are $9.99 per trade and you're only buying $100 or $200 worth of a stock, that percentage of the overall amount you're investing is quite large. As your portfolio gets larger, typically your costs as a percentage drop, making it far more economical to support the costs of advice. The other point I would make is when you're starting out, you don't have a lot of money at risk. So the damages you might sustain from making an early mistake in your portfolio usually are a lot smaller, and therefore you could argue that the need for an advisor might not be as important. This could be very different from having a sizable retirement portfolio close to retirement of, say, $2 million. A mistake with not a lot of working time left and a larger amount could be far more detrimental. An analogy we use to describe this better is in the area of whether or not to use a lawyer with different levels of legal issues. Let's say that you're in your car one day and you lose track of the speed you were going and you get pulled over for a speeding ticket. The amount of the ticket and the level of legal risk could be like your account when you're starting out. A ticket is a relatively low risk when it comes to financial risks and jail time risks, and there would be little in the way of serious consequences should you decide to fight the ticket and lose. Hiring a lawyer, or in this case a criminal defense attorney, is unlikely to be cost effective, and a lot of people would agree it's pretty unnecessary when defending a small thing like a traffic ticket. If you lose, you might be out a little bit of money, you might have a few demerits, but it's probably not going to affect your life in any way. Now let's take another look at hiring an advisor when the legal issue is a lot more serious. You now, instead of being pulled over for a speeding ticket, you've been arrested for a murder you didn't commit. You are now facing life imprisonment with no chance of parole. Now I am being a little bit dramatic here, but when you approach retirement, the feeling can be similar. If you're 57, 58, you have very little working time left to be able to recoup any money you might lose in the event of a serious loss. And because you've been saving your whole life, you now don't just have a few $100s to lose, you could have several million. This could very much feel like your life is at stake, similar to a murder charge. The question you have to ask yourself is, are you comfortable defending yourself in a murder trial when your life is at stake? The cost of hiring a lawyer, or in this case a criminal defense attorney, in relation to being locked up for the rest of your life is absolutely insignificant, similar to having a large investment account. As your account becomes more and more and more valuable, your costs usually become smaller as a percentage. Now maybe you've studied law since you were young and are quite capable of defending yourself, and that's all fine and good. But I think many people in this scenario would in fact seek out the best criminal defense attorney they could find. When starting out, keep your costs as low as you can, and when your account gets larger, consider hiring an advisor. Rule number 10, properly allocate your assets. Start with an overall picture of your portfolio and look to build an asset allocation strategy based on your age, income needs for retirement, risk tolerances, and then execute your asset allocation strategy with securities that fit your model. Be careful to allocate reasonable concentrations by sector, country, and market capitalization to ensure that you are diversified properly, and avoid taking on the undue risks in the market. Proper asset allocation can go a long way to safely building your net worth over time. And for everyone, here's a bonus law. Do not try to beat the market. Beating the market is virtually impossible to do over a long period of time, as the market indexes are only mathematical calculations and play by different rules than humans when it comes to retirement needs. In the future, I will be doing an entire video on why trying to beat the market is not something that you should be probably attempting to do, but instead try to use the great stocks within the market to achieve a reasonable risk-adjusted personal benchmark rate of return for you. This is usually far more beneficial to investors than trying to beat a market that is often wild, unpredictable, and super volatile. And in closing this video, if you like what you've seen, please hit that like button for the YouTube algorithm. Make sure to tap that subscribe button and darken that notification bell so you can be notified of all my latest videos. Until next time, this is Joe Macek, Portfolio Manager with IA Private Wealth. We'll see you soon.